If you operate in Africa and the Middle East and still rely entirely on traditional cross-border payments, you are paying too much, waiting too long, and tying up cash you don't need to. That's not a theory, that's what the numbers show these days. And that's why stablecoin payments are quietly becoming part of the financial backbone in emerging markets. Welcome to the Real World Blockchain. This is a podcast about how blockchain is actually used in real world businesses environments. We focus on payments, settlements, liquidity, compliance, and just basically day-to-day operations. Today, we're talking about stablecoin payments and why they matter right now for companies operating in Africa and the Middle East. In many parts of the world, payment systems simply don't work as well as they should. For instance, I have clients in South Korea. Whenever they pay me, the banks, the intermediaries, they take a big chunk of my money, and that's not acceptable today in the 21st century in 2026. Let's look at the basics for that. So according to the IMF, cross-border payments in emerging markets are still pretty slow. They are costly, they're hard to track, they rely on long chains of correspondent banks, each adding delays and fees, obviously. So on average, international remittance costs sit around 6%. The G20 target is 3% as a comparison. And in several Africa-related corridors, costs are even higher, often 8 or 9%. For businesses, of course, that directly impacts their margins, their cash flow, and their execution speed. Stablecoins don't fix everything, obviously, but they do solve one important problem: moving stable value across borders at any time with fewer intermediaries. The IMF has pointed out that when properly regulated and integrated, stablecoins can reduce settlement delays, they simplify reconciliation, and they improve liquidity management. That's why the conversation has changed. So stablecoins are increasingly treated as actual payment tools rather than speculative assets. When existing systems become too slow or too expensive, businesses adapt. It's as simple as that. Sub-Saharan Africa is a clear example of this. According to Chainalysis, the region consistently ranks among the top globally for crypto adoption, with Nigeria playing a central role in that. And what's especially interesting is that on-chain activity tends to spike during periods of foreign exchange stress. So that tells us a lot, right? Stablecoins are being used when traditional systems kind of struggle. For businesses operating across African markets today, stablecoins are already used to pay suppliers abroad, receive dollar-based revenue, and hold value in stable units, and move money across fragmented banking systems, of course. So there's an important point here. Stablecoins by themselves, they don't create value, right? But the infrastructure does. That's why moves like Flutterwave acquiring Mono are so important. It may not sound like a crypto story, but it shows where the real work happens. Payment rails, bank connectivity, compliance, and enterprise integrations. Tokens don't replace infrastructure, but they connect to it. In emerging markets, speed without compliance doesn't scale, and compliance without speed doesn't stay competitive. The Middle East follows a different path, but the direction is just as clear. In places like the UAE, regulators have taken a structured, pragmatic approach to stablecoins. Recent regulations frame them as payments instruments rather than speculative assets, as I said. And we're already seeing the impact on real payment infrastructure. So one strong signal came from Network International, one of the region's largest payment processors, announcing support for stablecoin-based payments through a regulated banking partnership involving AECoin. Banks are involved, payment processors are involved, and stablecoins are entering regulated payment environments. On the institutional side, Reuters reported that Barclays invested in Ubix, a company focused on stablecoin clearing and settlement. So that matters. When major banks get involved in settlement standards, interoperability, and risk management, stablecoins move into the background. They become part of the plumbing, basically. So at this point, the question is no longer whether stablecoins will be used. The real question is who adopts them early and who ends up playing catch-up in the end. Legacy players are already moving. The Wall Street Journal reported that Western Union is preparing a dollar-backed stablecoin to reduce settlement delays and transfer costs. Western Union operates at massive scale, right? So margins are tight. Efficiency matters. So this lines up with what many enterprises already see. The competitive edge is shifting towards faster, cheaper, and more predictable payments. That's as simple as that. Across Africa and the Middle East, two use cases dominate: remittances and B2B cross-border payments. The challenges are the same in both cases: slow settlements, locked up liquidity, and complex reconciliation. Stablecoins don't remove banks from the equation, they make the connections between them more efficient. So at this stage, technology isn't the limiting factor anymore, I would say. So integration is. Let's be very practical here. If you're a CFO, a finance lead, or basically an operations manager, let's say, working across emerging markets, there are three questions worth asking. Which payment corridors cost the most today? Where do settlements delay tie up working capital? And can stablecoins act as a neutral settlement layer without forcing major international changes? This is where many initiatives fail, not because blockchain doesn't work, but because it doesn't fit into the existing ERP system, the CRM workflows, the approval processes, and the compliance requirements as well. So if a payment solution forces a company to reorganize how it operates, adoption slows down fast, right? That's where Web3 enablers, that's us coming in. With blockchain payments for Salesforce, we enable stablecoin and blockchain payments directly inside Salesforce, where enterprises team already work. So companies don't need to rebuild their systems or run parallel finance processes, right? Blockchain payments are embedded into existing workflows, approval processes, approval layers, compliance controls, and ERP connected reporting. For companies operating across Africa and the Middle East, this means what? Faster settlement, clearer treasury visibility, and access to modern payment rails without operational disruption. Blockchain stays in the background and teams can focus on their business. Stablecoin payments are no longer a future concept, they are already changing how money moves in emerging markets. If this topic speaks to you, I'd be happy to continue the conversation. In person, I'll be attending Cairo Dreaming this Saturday, January 31st, representing Web3 Enabler, to discuss enterprise blockchain, stablecoin payments, and real-world use cases with the Salesforce ecosystem. If you're there, come say hello. Thanks for listening to Real World Blockchain. Subscribe, share the episode, and see you next time. Cheers.